I'll get us started here today. Hi, everyone, and thank you for attending week 2 of BFSG's fall webinar series. My name is Erin Schneider. I'm an investment research analyst here at BFSG, and I'm joined today by Paul Horn, and Marilyn Blank will be with us momentarily. Our topic today is navigating your tax strategy, where we will discuss ways to help minimize your taxes before year end, planning for business owners, executives, and individuals with stock options. We'll also take a glimpse into anticipated tax changes and how to prepare for those.
Thank you so
Yeah,
much, Aaron. Hi,
absolutely.
everyone. My name is Paul Horn. I'm the Director of Financial Planning here with BFSG. I do a lot of tax planning, helping our clients along the way. One of the people I work closest with is Marilyn Blank. She is a CPA. She has her own practice. She's a wonderful resource for us over the years. Marilyn, can you introduce yourself a little bit more?
I'm Marilyn Blank. I'm a CPA. I've been in Lake Forest, California for 30 plus years, working with individuals, small, medium, large size businesses. And I'm happy to be here to help you navigate this new tax world, old tax world changes, whatever's going to happen in the next year or two.
Perfect. Thanks so much. All right, Aaron, do you want to go ahead and launch our first poll?
Because of the recording, I'm going to go ahead and read the question. It should be popped up on all your screens now, but I'll read the question and answers aloud. When do you normally do tax planning? When I file taxes, after the new year, before the end of the year? Why should I do tax planning?
All right, thanks. Very interesting mix here. We've got 34% say when they file taxes. This is honestly historically what I see for most clients that I work with. After the new year, this makes sense when people start getting their W-2s, 1099s, their tax docs, they start thinking about it. And in a very pleasant surprise here, about 1/3 of all people do their tax planning before the year end. If we talk about anything in today's webinar, this is what I want to drive home. Everyone should be looking at their tax situation after October 15th, but before around December 1st. So in that kind of 6-week window of like early December, late October to early December, you really should be talking with a financial planner or a CFP just to understand your tax situation and see what can be done to maybe lower your taxes.
But if I can add to that, really the best time to do it is in the middle of the year when you can plan for strategies that take time to implement and you can get it done before the end of the year. The problem, I mean, yes, toward the end of the year, in that sweet spot, October to the beginning of December, you kind of have a little bit better idea of what's going on with your taxes for the year. But there's a very short window to get things done. So I'm suggesting July. CPAs, a lot of people are much calmer and have more time to help during the summertime.
Thank you. That's an excellent point, Marilyn. And you're absolutely right. If you are doing a more complex transaction like a net unrealized appreciation transaction, more commonly known as an NUA, those take time. We're talking 4 to 6 weeks to get those done. So if you wait until end of the year for a complex transaction like that, may not get done in time. So important dates to remember before year end. The first one is going to be just looking at open enrollment for Medicare. So if you are enrolled in Medicare and thinking about making changes, now is your window to do so. It started October 15th and it runs through December 7th. If you have Medicare and didn't watch, we had a wonderful webinar over the summer with Brian MacArthur talking on this topic. So if you have any questions on that, I would strongly recommend to watch the replay, but just something to keep in mind there. Now, December 31st is the end of the year for most of the more common types of transactions or tax planning strategies that I see. Along with these are going to be making charitable giftings, whether it's a qualified charitable distribution, gifting cash or appreciated stock to charities, doing Roth conversions, or just maxing out your accounts with your employer, whether it's a health savings account or it's a 401k or 403b. Any contributions to those type of accounts need to be done by December 31st. And then finally, if you're making any personal gifts to friends or family, want to have those done before year end as well. Marilyn, is there anything you'd add here?
I usually tell people when they're making gifts at the end of the year, If they can make them slightly before the end of the year, the IRS does like to see those checks clear in the year that you're making the gift, so that you're not giving a gift and the check's not clearing, and then there's question about really, not clearing till the beginning of the next year. Then was that gift in that year? Because you want to try to, if you're going to be giving gifts every year of 18,000, you want to do it kind of at the same time and get it done sooner
Absolutely.
rather than later.
All right. So there's a lot of different tax strategies that we're going to talk about here, but they can be really broken down into one of four different areas, whether it's investment portfolios, income tax planning, retirement planning, or charitable gift and legacy planning. We will be providing a one-page checklist at the end of today's broadcast. So if you'd like to get that checklist, feel free to reach out and we can provide that to you. But ultimately, all we're trying to do here is keep more money in your guys' pocket, right? With all this planning that we're talking about, it's just trying to help you not evade taxes, but lower your taxes and pay as much or as little as you can. We don't want to overpay what you owe to the IRS. All right, so let's go ahead and start with the investment planning. When we're looking at investment taxes, it's interesting to note that there's actually two separate taxes most individuals will pay. We all know the first one, and that's your ordinary income taxes. Just that's the taxes on your normal wages that you pay. The second tax that we pay, and not everyone's aware of this, is going to be on our capital gains. So if you have an investment, let's say you invest in XYZ stock, and you buy it for $100 and it goes up to $120 and you sell it, well, you have a $20 gain. Well, that gain might be tax advantaged or taxed at a lower income rate than your income taxes. How that is determined is how long you held the investment. So if you hold the investment for less than 12 months, so let's say you buy Tesla January 1st of this year and you sell it now, well, you've only held that for about 11 months. You haven't met the full year. It's going to be taxed at ordinary income tax rates. If you hold it for at least 12 months, so let's say you bought it October of last year and you sell it November this year, you're over the 12-month holding period. Now you can get it at a lower tax rate. So where a lot of individuals might be paying 22, 24%, or as high as like 32, 35% on their income taxes, you can see here on the long-term capital gains, it tops out at 23.8%. If you have a lower income, there's a chance that you actually may pay zero taxes. So if you're in the 10 or 12% tax bracket, you're not going to pay any taxes on long-term capital gains. And again, that's an investment that you hold over 12 months. So what you're seeing here is just based on your income and how you file. At 250,000 for someone that is married or 200,000 for someone that is single, if your adjusted gross income is above those numbers, there is a 3.8% surtax that gets added that's known as NIIT, the net investment income tax. So that's how you go from the 15% rate to the 18.8%, or the 20% rate is actually 23.8 when you add the NIIT. Marilyn, anything you'd want to add here?
Yeah, another way to get long-term capital gains rates has to do with your dividends. And that is when you get dividends on stocks, there's a portion of those dividends that are considered qualifying dividends. And you want to try to hold stocks for a longer period of time. If you're in a dividend earning portfolio, you want those dividends to be qualifying dividends, because any part of the dividends that are qualifying also get the capital gains rate of 15%. So if you were in the 35% tax bracket and you had no qualifying dividends, all your dividends were just ordinary dividends, you'd be paying 35% tax. If a portion of them, or even up to 100% of them, were qualifying dividends, you'd be paying 15% tax on those dividends. So that's a 20% spread, which is a pretty substantial tax savings.
Oh, absolutely. I had a client a couple years ago started trading options and stocks on their own. Started with a very large portfolio. They're doing very well for themselves. They had $600,000 in gains that year. The challenge is they were doing trading. They were holding all the positions for less than 12 months. So at the end of the year, he's in the 35% tax bracket. He's paying 35% federal taxes on that money that he made. Where if he had held the investments for a year and then sold them, instead, he'd be looking at the 18.8%, literally could have saved about half his taxes that he paid to the federal government. So it is important consideration when you're doing your investment planning. All right, let's talk about capital gains or losses. Okay, so at the end of the year, we add up all the gains, we subtract all the losses from that. So we have to look at this not just not just pluses and minuses, but we also have to look, is it short term or is it a long-term capital gain? Because that's going to impact how you pay taxes on your capital gains. So let's say you have a positive short-term gain and you have a positive long-term gain. Well, all that's pretty simple and straightforward then. Just whatever your short-term capital gain is, it's going to be taxed at ordinary income tax rates. Whatever your long-term gain is, it's just going to be taxed at the long-term capital gains tax rate. Simple and straightforward. Gets a little bit more complex if you have combinations. So let's say that you have a long-term gain of 6,000, but a short-term loss of 4,000. Well, in that case, you're going to net the long versus the short. So that's going to give you about $2,000 left over in capital gains, right? Just 4,000, sorry, 6,000 minus 4,000. And then with that 2,000, it's just going to be looking to see if it's long-term or short-term, and it'll be paid at that applicable tax rate. If you do have both losses, or let's say you have a long-term loss of 9,000, short-term gain of 4,000, well, that leaves you a $5,000 loss. And in that case, what happens is the IRS will allow you to deduct 3,000 against your income, and then the remaining balance, which would be 2,000, right? You have a $5,000 loss. We can use 3,000 right off income. We have 2,000 left over. That 2,000 isn't lost. It's what's called a loss carry forward. So that can be used to offset income or offset gains in future calendar years. Now, this is an important tax planning strategy here. If you are looking at trying to manage your capital gains, there is a strategy known as tax loss harvesting, and that's where you sell a stock and lock in that loss, and then you can invest that money somewhere else. So if you have a position that you're not very fond of that has a loss this year and you have a lot of gains, it might make sense to sell that position, buy a different position. We don't want to trigger what's called the wash sell rule, where you sell the stock or investment and you go back and buy it within 30 days. The IRS cancels the transaction, treated though as the transaction never occurred. So we want to do things like sell Coke, buy Pepsi, sell XYZ fund, go buy ABC fund, that sort of thing. But if you do that, you can lock in those losses and that can help lower your taxable gains.
And if you did want to stay in that position, you would need to wait 30 days before you buy that same stock again. Because I see a lot when we're doing tax returns on brokerage statements that there's a lot of wash sale losses that do not get allowed. And you actually then you don't get to take those losses. It'll roll forward, but when you sell the position again, but if you rebuy it within 30 days, you don't get to take the loss.
Yeah, typically I'd say about 45 days is a safe spot just to avoid any challenges or not raise any red flags. All right, another important strategy is just to rebalance your investment portfolio. This is really important because what happens is portfolios drift over time. So if we look here at this model portfolio beginning January 2008, if you add all this up, it's 30% bonds, 70% stocks. Okay, and we're using 2008. We're cherry picking here, let's be honest, because it helps illustrate the importance of rebalancing. So 2008, we know, was the third worst year in stock market history. Most of the stocks lost around 35 to 40%. As we can see, bonds were actually up about almost 6% that year. So the portfolio that started 70-30 ends up being 42% bonds at the end of the year because bonds were the best performing asset class. And all the stocks that lost a bunch of money become much smaller. So what happens is your portfolio has naturally become more conservative right? You've gone from 70% stocks to 60% stocks. And so we just want to rebalance it to get it back in line with the level of risk that you're trying to take. And this is important in years like right now, where we're S&C and S&P up 22% year to date. Instead of having the bonds grow in the position, what's going to happen is your stock positions are going to get bigger and your portfolio might become 75 or 80% stock instead of 70% stock. And that might set you up for larger losses than you want to have if you're not rebalancing the portfolio periodically. This is something that should be done about once per year. If you have a 401k, the nice thing with that is most 401ks have an automatic rebalancing feature that you can choose to use. Check with your 401k specifically. Not every single one has that. So when we are rebalancing portfolios, there are some important things to consider. The first thing is when you are rebalancing portfolios, if you're doing it at the same time every year, like every June or every December or whatever date you pick, the nice thing about that is it creates a disciplined approach. So you're making investment decisions that are helping your portfolio, and it helps remove the emotions out of the decision-making process on investments. And this is really important because emotional decision-making is the number one reason for bad performance in someone's portfolio. So just taking that disciplined approach does help remove the emotions out of the equation to some degree. It does help you encourage buying low and selling high. So if your stocks are overperforming, you're going to sell the winners and you're going to try and buy today's losers because today's losers hopefully become tomorrow's winners. Doesn't always work that way, but it does encourage that. Now, there are some things to consider. Obviously, if we're rebalancing in a taxable account, you're creating taxes. We're creating those capital gains that we talked about. So those need to be taken into consideration. There may be trading costs depending on where it's held and how the money is invested. So you may be incurring trading costs. And we've talked about the wash sale rules, but if you're selling a stock or any mutual fund, ETF, whatever it is, you got to wait the 30 days that we talked about before you buy that exact same position again. And it is important to review your overall strategic allocation. Maybe you were 70-30 10 years ago, but you're going to retire in 2 years. Maybe it's time to rethink your overall allocation just to make sure it still makes sense to where you are at today. All right, Marilyn, can you talk about life events and how do life events impact people's tax planning?
Oh gosh, so many different ways. Obviously, if you get married, you go from filing single to usually married filing jointly, which puts you into a different tax bracket, and it depends on whether both of you are working or not working. Divorce is the same thing. You become single and or head of household, so you need to understand what options are that you have. One of the new rules that happened in 2018 was that alimony for federal purposes is not taxable to the person receiving it, and it's not tax deductible to the person paying it. That's for federal. What people don't realize is that that is not the law for California. So alimony is taxable to the person receiving it and deductible to the person paying it. So that's very important. That kind of gets lost a lot of times. Having children gives you more potential credits. Of course, you need to then start saving for their college education the moment they are born so that you can afford college in 18 years. Death is a big thing. I mean, it causes a lot of potential taxes, a lot of stress, so not only is there just the practical, but it's a very emotional event. Well, as is divorce and all the other things, but all these things have impact on your taxes. So you need to talk about them to your financial advisors, including starting a business and being self-employed.
Yeah, that's a big one. If you're self-employed, definitely talk with a financial advisor or CPA because there's going to be a lot of avenues that you didn't have access to in the past for tax deductions. All right, our next poll question.
All righty. You should see it pop up on your screen now in a moment. Again, I'll read the question and answers aloud. Do you normally use the standard deduction or itemized deductions? A, I don't know what this means. B, standard deduction, C, itemized deductions, or D, whatever my tax preparer tells me to do? Most popular vote would be the standard deduction here. Few itemized. I'm glad to see only 5% of us don't know what this means. I know our presenters will go into this momentarily.
So I will explain. So you have a choice of either itemizing your deductions or taking the standard deduction, which means you don't have to fill in anything on Schedule A, which is the itemized deduction worksheet of your tax return. And itemized deductions include possibly medical expenses, state and local taxes, including property taxes, mortgage interest, and charitable contributions. So a lot of you said that you take the standard deduction. So for a married filing jointly person, that's $29,000. If your mortgage is paid off, the state and local tax is limited to $10,000, and you don't do a lot in charitable contributions, or even if you did do $10,000 in charitable contributions, you're only at $20,000. The standard deduction is going to be higher. However, California, if you're a California resident, California standard deduction is a third of that number. So when people say, oh no, I didn't give you my property taxes, I didn't give you anything because I'm just going to take the standard deduction. But California standard deduction for married filing jointly is only $11,000. So property tax counts in full. So on federal, if your property taxes are $12,000, even though they're limited to $10,000 for federal, you get to take the full $12,000 on California. And so if you do have some mortgage interest, charitable contributions, you will get the benefit for those on California. So don't just plan on saying, oh, I just take the standard deduction, because in many, many cases, your tax preparer is going to need all of your deductions anyway, so they can see which one is higher. And also, if you are in California, you may get a benefit by itemizing.
That's an absolute fantastic point there, Marilyn. That is something that is unique and something I have seen pop up in the last couple of years where people are taking the standard federal but itemizing their state. So this is why you need to talk to a tax preparer so you're paying as little as possible in your overall taxes. Sorry about that.
Clarifying
Only thing,
question just come in. Sorry not to interrupt
yeah.
here. Someone's asking, why is the California so much lower on the standard deduction? Would this apply with federal? Just to clarify.
I
you'd
don't
have
know
to
the
ask
reason.
Yeah.
Go ahead.
So right now is kind of a unique situation where the tax law under what we're under at now is what's called the Tax Cut and Jobs Act, TCJA for short. The tax rules as they stand today at the federal level are set to expire end of next year, and they're supposed to revert back to the pre-2018 tax code. So because this was temporary, not every state followed it. I'm guessing that might have something to do with it with California, but California is more following the old tax code, not the temporary new one under the TCJA. That's the best that I got in terms of
Yeah,
guess.
that's correct, because prior to the Tax Cuts and Jobs Act, the standard deduction was about half of these federal amounts. It was about half. So it wasn't that much different than the California amounts. But once the Tax Cuts and Jobs Act, that act doubled the standard deduction. So there's been a discrepancy since then. And because the standard deduction is so large, people just assume they don't have enough to add up to get over the 29,000, but they very may well have more than the California. So they still need to get all that stuff together.
Excellent. Only thing I would add here too is if you're 65 or older, on the standard deduction, you do get a bonus of $1,550 per person. So if two people are over 65 married, they each get that $1,550, or if you're single, it's $1,950 additional deduction that you get. All right. Can you explain to us, Marilyn, this California pass-through entity tax and how it works?
So under the Tax Cuts and Jobs Act, the state and local taxes were limited to $10,000. That's called the SALT limitation. State and local taxes limited to $10,000. So previously, you could deduct on your federal return all of the taxes that you paid on your state income tax return, all of your property taxes for your houses, however many houses you may have, your car registration, and you could deduct whatever that total amount was. With the Tax Cuts and Jobs Act, when it got limited to $10,000, and that was back in 2018. So it took a couple of years, and everybody was trying to figure out, how do we get around this $10,000? So the states came up with a program that the IRS and Congress bought into and said, this is fine, we'll allow this to happen. So starting in 2021, maybe was the first year that
22 through 25.
Pardon?
It's 2022.
Well, actually, 2021 was the first year.
Oh, interesting.
Yeah.
I got an error on my slide.
Yeah. So what happened was they determined that for a pass-through entity, and a pass-through entity is a multi-member partnership or LLC, an S corp. Well, that's basically it, and or basically it. That's it. And
Marilyn, question for you. What about like sole proprietorships or single member LLCs?
No,
Do they
those are
qualify
not
for this?
considered pass-through entities. And it's an
Okay.
entity, a separate entity that passes out its income to the individual return. A single member LLC is a disregarded entity, so it just goes on your tax return as a Schedule C or a Schedule E. Sole proprietor is just a Schedule C on your personal tax return, so that's not considered a pass-through entity. It has to have a separate tax return. So they're allowing the fact that you can now take the California net income, multiply it by 9.3%, and have the entity pay a payment to the state of California, which is effectively your estimated tax payment, and it goes towards your California taxes. But for federal purposes, you get to take that state tax deduction. So if someone made $200,000 on an S corporation, this is their net income on their California return. They get to take 9.3% of that. I'll just use 10% to make it easy. So $20,000, they get to pay that in. And if they do it during the year, whatever year they pay it, they'll get the tax deduction for it, but it will be credited to that year's personal taxes. And on your federal return, you will, on the business return, you will get a deduction for that $20,000. So if you're in the 35% tax bracket, you've just saved $7,000 by having your business entity pay your state taxes for you. And when you file your state tax return, you'll get that $20,000 as a credit against your California taxes. So it is, for the most part, 99% of the time, maybe 95% of the time, it is a winning situation. And it's a definitely amazing tax benefit that it is truly amazing. In some situations, so someone might have a business, but then they have a lot of, they pay into a retirement plan. They have a lot of charitable contributions. So when you get to your actual California tax return, your business income of $200,000 has been reduced by all these deductions, and you might have zero tax. Well, they have a credit of $20,000, and unfortunately, they don't give it back to you. They let you carry it over for 5 years. So you've kind of like prepaid your taxes. But if you're not going to have a lot of state taxes in the future, then it's not worth it. You've actually just lost $20,000 net, the $7,000 that you saved on the federal taxes, you're out $13,000. So there is tax planning involved with getting this pass-through entity tax. But if you haven't been doing it, 24, 25 are the last years. If the SALT limit continues, the states will probably continue doing it. but based on the Trump program, they're trying to, well, based on who the next president is, the Tax Cuts and Jobs Act are probably going to be extended, but they are going to try to change this SALT limitation. So the states say if the SALT limitation goes away, they're not doing this anymore. And every state is different, so you do have to check. For instance, Hawaii, it is not only not refundable, but it's also, you can't carry it over. So sometimes if you have property in Hawaii or investments, real estate in an entity, it may not make sense to take the Hawaii. We found on a couple of clients that they would have just totally lost. So that's kind of the short answer, but you do have to do planning on this.
Yeah, definitely consult with a CPA, not a financial advisor. Consult with a CPA on this one specifically.
Yes.
All right, so let's talk about what are some planning that can be done for business owners.
So obviously there's a whole list of things for business owners. You can write off all your ordinary and necessary business expenses. If you do use a home office, you can take a home office deduction. It applies differently to businesses as an LLC versus the sole proprietor versus an S corp. So there are some nuances to that. Purchasing equipment.
Sorry, real quick, Marilyn, is the home office deduction still a red flag for the IRS?
It's not a red flag as long as it is used correctly. I haven't had a home office deduction audit. I've only had maybe one or two. I haven't had one in 15 years.
Wow, okay.
It's pretty prevalent now because a lot of people do work from home. It doesn't benefit you if you're a W-2 employee. That deduction has been lost again in the Tax Cuts and Jobs Act. For federal purposes, it may benefit you on California, but not so much. But in terms of, other things, the new equipment, the auto purchases, again, bonus depreciation was a big thing, which is now bonus depreciation for 2024 is at 60%, where it was 100. It's gone from 100 to 80. This year it's 60. It's going to go to 40 and then 20, but that's also being looked at in the Trump tax plan. Retirement plan contributions are a big thing. One of the biggest benefits you can get as a business owner versus being an employee. Setting up your own retirement account and this credit. The qualified business income deduction, which is 20% of your net income for businesses that do qualify. And finally, I'll just really briefly mention this Corporate Transparency Act. There's a limited amount of time. If you have your entity or your business is incorporated, meaning an LLC registered with the Secretary of State, a corporation registered with the Secretary of State, you do have to file this beneficial ownership report before December 31st, 2024. And you can do it easily yourself by logging on to fincen.gov, fincen.gov, and their front page, click on file here. You have to put in the owner's information and upload your driver's license. But it is important that be done before the end of the year because there's substantial penalties if you don't do it.
Yeah.
So that's all I have on that.
Perfect. All right. So let's talk about income tax withholding. One of the big reasons I like to do tax planning with clients towards the end of the year is just to check to make sure that they've withheld the proper amount of money. So if you are a W-2 employee, you receive your paycheck each biweekly or twice a month or whatever it is, and you're paying your taxes on your paycheck, this probably doesn't apply to you as long as you chose your withholding correctly. Probably not too much to concern about. Where I see this being more of an issue is for business owners and retirees that are choosing to pay quarterly taxes. That is typically where I'm seeing the issue here, where maybe there's an underpayment. The whole idea here is IRS says you need to pay either 100% of your prior tax year liability, 110% of previous year if your AGI is above 150, or 90% of your projected current year liability. Cannot talk there. So all we're trying to do is avoid additional penalties on the withholding. So you don't want to get, retire your first year, start paying quarterlies, you're underpaying, and then you find out next April you owe $5,000 or $7,000 in taxes. We're just trying to avoid that sort of situation with this type of planning. Anything to add here, Marilyn?
Yeah, so important planning about this is the IRS underpayment rate used to be 3%. So a lot of times people would say, I don't care about paying my estimates. I'll pay the IRS penalty because I'm making way more than 3% in my investments. The IRS and California underpayment rate now is 8%. So it's a little bit different and it adds up. Now it's almost 3 times the penalty that was before. So it's a substantial amount when you're talking about 8%. The other thing you mentioned about people having withholding, and so they should be covered. I do find a lot of people, especially a lot of higher income earners, do not have enough withholding. And this is usually because they get paid bonuses or they get paid commissions, and those are withheld at the statutory rate of, I think it's 25% federal. When they may have these bonuses or commissions may have put them in the 37% tax bracket. So we do their tax return and they've only had withholding and they owe $15,000, $20,000 and they're shocked. It's because they haven't had enough withholding and they think they've had enough because it's like, I got a bonus and there was hardly anything left. But unfortunately, this happens a lot. It doesn't happen as much on California because California's statutory bonus commission withholding rate is 10.3%, which is higher than their 9.3%. I mean, there's a 10% tax bracket, but a lot of times those people are still, those taxpayers are still in the 9.3% tax bracket and they've had bonus withholding at 10.3. So California, they're usually fine. So taxpayers should always check their pay stubs and see where they're tracking and compare it to the prior year. And they can have their CPAs, tax preparers, check it also to make sure that they're going to be on track and having the right amount of withholding.
All right. So it is important not just to focus on federal taxes, but to focus on state taxes as well. So, if you live in California, most people tend to fall in that 9.3% bracket, as Marilyn just stated. If you are making over $1 million a year, it could be as high as 13.3%. Other states are a little bit lower. And for California, this is just what I call the sunshine tax. It's the price of living in the beautiful weather and the beautiful scenery. Other places like Nevada or Texas, there is no state income tax. So you may not pay taxes there, but they'll get you another way, whether it's sales tax or property taxes or something like that. This is an important consideration to look at when you're doing tax planning. And just a little side note here, it's important to do when you're looking at retirement planning as well. A lot of people tend to move when they retire. I've seen a real life example client from Illinois considering moving to Florida because Florida has zero taxes. Illinois has a pretty high tax rate when you go into it. However, Illinois doesn't tax retirement income. So Social Security and pensions are not taxed. That was the client's primary sources of income, was a very large pension and some Social Security. So when we did the math, it didn't make any sense to move to Florida, at least from a tax perspective.
From a snow perspective, it makes sense to move from Illinois to Florida, though. Another point about that, because people are looking for states that don't have any income tax. So for instance, Washington State, which has had no income tax, they now have a small potential capital gains tax. But what they also have, which people don't realize, is they have an estate tax. California does not have an estate tax. So I recently had someone, they were not my client. I ended up actually working on their estate tax returns, but they were a resident of Washington. They had a very large estate, mostly in appreciated real estate, as part of their business. So they weren't cash rich, they were real estate rich. And they actually moved from Washington back to California to be a resident of California, to pay California resident income taxes, because upon their death, if they were still a resident of Washington, they would have owed $8 million to Washington for estate taxes. So things aren't always what they seem to be in states that have no taxes. So there are some a handful of states, maybe 11 or 12, that do have an estate tax. So you should be aware of that too before you move, and understand how that would impact your situation, because Washington, anything over $2 million is a taxable estate. And a lot of times people move there and they have a house and they have a retirement and they have 401k and they're over that amount.
Absolutely. All right, so let's talk about managing your tax brackets, okay? Some people's incomes are pretty steady year to year, and that's great. There are still some planning available there. But what happens if your income is a lot higher or a lot lower than it is in previous years? Maybe you started a business and your income just doubled overnight because the business is doing really well. Maybe one of the spouses got laid off, so they didn't work 9 months out of the year. So when you have things like that, there are planning opportunities that you can find. So in a higher tax year where your income is higher than normal, what we're going to try and do is defer paying taxes in as many ways as possible. So things like retirement plan contributions become very important. If you max out your tax deferred contributions to employer retirement plan, that lowers your taxable income. You're going to possibly want to consider accelerating charitable gifting. So if you're giving $5,000 a year to charity, maybe give 10 or 15 that year and kind of bunch them up so you get a larger deduction if you're doing itemized. Maybe you want to avoid capital gain recognition. So we talked about rebalancing. Maybe you're doing that every December. Maybe you just push that off until January to trigger the taxes in the following year. So we want to kind of avoid recognizing capital gains. But what we do want is, if there's any tax loss harvesting where we can recognize losses on our investments, we definitely want to try and do that to lower the gains and maybe get that $3,000 income offset if you have larger losses than gains. If you're taking money out of retirement accounts, you want to defer distributions that year. And then if there's any business expenses for pass through, you're going to want to bring those forward or make those large purchases in the year that you have a higher income as a business owner, because that'll help with lowering your taxable income. In a lower tax year, instead of trying to delay taxes, we actually often want to kind of lean into it. So there are times where it actually makes sense to trigger the taxes early. So let's say maybe you're married, combined income normally is 200,000, but this year it drops to 90,000 because the spouse was out of work. Well, you may want to do things like exercise stock options or other things that can be done to accelerate your income recognition. You may want to delay the charitable gifting because you're not going to get as much of a benefit in a lower tax year. Here again, we want to pull taxes forward. So let's recognize the capital gains when we're in the lower tax bracket, or maybe consider something like a Roth conversion, which will create taxes, but that's going to give you tax-free money for the rest of your life. And if you do have large expenses for a business, maybe delay those where you could take advantage of that in a year where you have higher income and get more of a benefit.
So yeah, I would just add to that, back to the point of tax planning shouldn't happen in April when you go to do your tax return, because I see a lot of times where no one's the taxpayer has not contacted me, and it's like, oh, you retired and you haven't taken any. This would have been a good year, or the prior year. It's too late in April, but the prior year could have been a good year to do some Roth conversion or to accelerate or to take an amount out of the IRA to live on, and it would have been at the 0% tax bracket. But if people don't contact me before or their preparer before the end of the year, just to say, hey, this is what happened. Is there, during the year, is there anything else I should do? It doesn't have to be a long conversation. It can be a 15-minute thing when they say, I stopped working. I didn't get another job. Should I do this and that? It can be a half an hour, and it will be the best half an hour that you've spent to save tax money. So just to keep that in mind, to converse with your tax preparer before the end of the year, even if it's just a quick, and I might say, nope, you're going to be in the same tax bracket. Everything's the same. There's not a whole lot of stuff you can do before the end of the year, but try this or that, or there's an opportunity. But once it's April, the opportunity for the prior year has gone.
All right, so we got our last poll here, Aaron.
We've just launched. Again, I'll read the question and answers aloud. What type of retirement account do you currently contribute to? An employee-sponsored plan, so a 401k, a 403b, a traditional IRA, a Roth IRA, a self-employed retirement plan, or a simple IRA or a SEP IRA, or E, I don't contribute. It looks like most of our participants here are contributing to their employer-sponsored plans, 401ks or 403bs.
So I have a couple comments about that. A lot of employers now have a Roth component to their 401k because most people said they weren't contributing to a traditional IRA or a Roth IRA because there's income limits. And a lot of times now you're above the income limit, so you cannot contribute to the traditional or the Roth IRA. However, more and more employers are allowing a Roth component as part of your 401k. So you should start considering maybe splitting up your contributions between the tax deferred regular 401k and putting some money into a Roth. The plans are also allowing Roth conversions within the plan. So if it's all in the regular 401k, you have opportunities, again, that's going to be a taxable event, but there is a way within the plan to do Roth conversions and start moving some of it into the Roth component. Because otherwise, for those in high income, it's going to be hard to get money into a Roth until you're way down the line in towards retirement. But even then, people think, I'm going to be in a lower tax bracket when I retire. And I start finding that people are in the same and or higher tax bracket when they retire because they've got a lot of investments. They've got a lot of money that they're still generating. They still might be working part-time. And then all of a sudden they have to start taking their RMD. Then they start taking Social Security, which is taxable at the moment. And so then, they're not really in a different tax bracket. And so it's going to be hard sometimes to do the Roth conversions. Then you start looking at how it's going to affect your Medicare premium. So then it just gets a little bit more complicated. So I think taxpayers should start checking with their employers to see if there's a Roth component as part of their plan. And the other thing about the self-employed, which just mentions the simple IRA or the SEP IRA, self-employed can also have what's called a solo 401k. So if you're a sole proprietor, you can have a solo 401k with a profit sharing component. And that profit sharing component is equal to the SEP IRA component, but you also get the 401k contribution. So you can put a lot more money away under a solo 401k than just the SEP IRA. So just keep that in mind too.
Yeah. All right. So these are just quickly the limits for contributions for some of the more common plans like 401ks, If you are over the age of 50, there is a catch-up that you have this year. So this year it's 23,000 plus if you're 50 or older, another 7,500 for a total of 30,500. For 2025, most of the numbers stay the same or went up slightly. So like next year, employees instead of 23,000 can do 23,500, but the catch-up contribution remained the same for those over 50. But next year does add a new layer where if you are a employee ages 60 to 63, you can contribute even more money than just the 7,500. Instead, you can contribute an additional 11,250. Now, what we saw was most people are contributing to the retirement plans with their employers. That tends to be the best way to go. Tends to be low cost, very high contribution limits. Most of them have the Roth conversion privilege, like Marilyn talked about these days. So for simplicity and accessibility, most people tend to do that. Now, some people do confuse the fact that they say, "Well, I have a Roth IRA," or they hear Roth, so they don't think they contribute to their Roth 401k. That's actually not true. The Roth 401k, just to be clear on this, has no income limits. You can make $10 million, still contribute to a Roth 401k, but you won't be able to contribute to a Roth IRA because there are income limitations on both traditional IRA and Roth IRA contributions. Where it gets a little interesting is, let's say you have one spouse that works, another spouse that stays at home. The spouse that works is maybe contributing to 401k. The spouse that's staying home, obviously, don't have a retirement plan to contribute to. Well, if their income is still is less than 230,000 married, what you can do is still make a contribution for the other spouse, so they still are building their retirement savings as well. And with these contributions to the 401k or IRA, you typically have until the tax filing deadline of around April 15th to make these contributions for prior year.
So we do have a question from someone asking, because their employer is no longer matching their 401k contribution, whether they should switch from the 401k to an IRA. I would say no, because number one, the IRA limitation again is only that $7,000 amount, and a 401k you can still go up to 23,500 or more.
Yep.
That's one reason. Another reason is if you continue working for the employer, depending upon your age, you can be over the required minimum distribution age. And as long as you're still fully employed by a company that's not your own company, you do not have to take an RMD out until you stop working for that employer. And also the 401k plan is protected from creditors. So,
Yep.
and IRAs are not. So your money is just a little safer in the 401k. And who knows, the employer may go back to offering matches in the future. But again, you should talk to your tax professional to determine what is the best. And if you haven't been maxing out your 401k, it might not make sense. Your income limit, it might make sense to start switching and putting 7,000 into a Roth IRA if your income is in the lower brackets and qualify. So there's a lot of ways to answer that. So there's not one answer to that.
Perfect. Thank you. And then HSAs, if you're family contributions, so married, it's going to be 8,300 with $1,000 catch up if you're 55 or older, or if you're single, 4,150 with $1,000 catch up as well. These are triple tax free, meaning you get a tax deduction when the money goes into the account. The money grows tax free, and it comes out tax free if it's used for qualified medical expenses. And if you don't ever use this while you're working, this can help fund things like Medicare or medical expenses in retirement. It's a fantastic account to take advantage of if it makes sense for you and your employer offers it. Now, we've talked a lot about Roth conversions already, so we'll just keep this kind of high level here. But with a Roth IRA, all we're doing is taking money out of a tax deferred account, like a traditional IRA, moving it to a Roth IRA. So The money that gets moved triggers income in that year, but then that money grows tax-free for the rest of your life. So it can be a great tool to help grow wealth over the long term. Definitely consult with a CPA and financial planner if this is something you're considering. There are a lot of variables that need to be considered, especially if you're close to 65, which is the age for Medicare, because things like Medicare costs that you pay in retirement are triggered by your income. So if you're doing too much or too large of a Roth conversion, that could actually increase the amount that you have to pay for your Medicare premiums, Part B and Part D. So things like this, we need to pay very close attention to when we're looking at a Roth. The other thing too is looking at something what I call the fill the bucket approach, where maybe you're in the 24% tax bracket. Well, maybe we just go up to the limit, but we don't want to bump you up into the 32. So we want to a lot of times keep you in the same tax bracket and just chunk them out over years, because you can do a Roth conversion for any amount at any time, but just know once they're done, we can't reverse them. The IRS says once it's done, it's done. So you got to do some planning ahead of time to make sure that you don't put yourself in a bad spot. Just some important ages to be aware of. If you're turning 50 this year, you do get that additional contribution amount to the 401ks that we talked about. So instead of doing 23,000 for this year, if you turn 50 this year, you can now do an additional 7,500 into the 401k or 403b. At age 55, if you retire from your employer and you have a 401k there, you can possibly begin to take money out of the 401k and avoiding that 10% early withdrawal penalty. You still pay income taxes on the distributions, but avoids the additional penalty of 10%, which is charged typically unless you're age 59 and a half, pulling money out triggers that 10% penalty. Again, 59 and a half, once you're there, you can take money out of your retirement accounts without any concern of any sort of penalty. Age 62, you can start Social Security at the earliest age. Most people's full retirement age for what's called your full retirement age or FRA for Social Security. This is the age that you can collect Social Security without any penalties. Is 66 currently. It's going to move to 67 here very quickly for future recipients. 65, we did touch on. It's when you're eligible for Medicare. And then qualified charitable donations. We'll talk more about these in a second. 70 and a half. And RMDs coming out of your non-Roth accounts starts at age 73.
And I want to make a quick point about the age 55 may be eligible to take a distribution from your 401k plan without the 10% penalty. That's because you've separated from service. That exclusion from the 10% penalty is only for a 401, your employer's 401k. So don't leave your employer, roll it over into an IRA, and then say, oh, I want to take $100,000 out and go on a year's vacation to Europe. You will get the penalty. The penalty only applies to the 401k and under the separation of service from your employer. So I've had this happen a few times where taxpayers did not realize that. They rolled it over and then said, I want to take a big amount of money. I want to remodel my house. I'm going to take it out. And then they got a 10% penalty, shockingly, but it's because they took it out of the IRA and not out of the 401k plan.
All right, last bit here is talking about charitable gifting and legacy planning strategies. So when you're doing charitable giving, there's different vehicles or different ways you can go about making charitable gift. Most people just give now. They'll either just write a check, maybe to their church or synagogue or temple, to the religious order, or maybe they transfer stock. Transferring stock is actually a better way of gifting because you don't have to trigger capital gains. So let's say you buy a stock that has 10,000 in capital gains and you want to make a large donation. Instead of writing a check, you can gift them the stock. The charity can sell that stock and pay zero capital gains. And then by you gifting the stock, you still get the full deduction, but now you don't have to sell that stock, so you don't have to worry about paying the capital gains tax on those large gains. So it can be a very effective way to gift and manage your taxes. Now, if you want to give over time, there are ways to do that. Most of the time, we either see what are called donor advised funds. That's a vehicle that's you would set up with like Schwab or Fidelity or Vanguard, a large institution. You put the money in now, you get the deduction now, and then you gift the money over time. Where we see this a lot is in those years where there is a large surplus. Most commonly, I see this with clients that are selling businesses. So we had a client last year sell a business for several $1 million. They made a very large, several $100,000 contribution into their donor advised fund. They get the deduction in that year for the contributions to it, and then they're using that donor advised fund to fund their gifting over the rest of their lifetime. So there is planning like that that can be done if you have a year where you have a huge increase in salary or income, shall we say. And then the last one is just giving and receiving income over time using trusts or charitable annuities. I would say the most common I'm seeing is the donor and advised fund. Oh, sorry, forgot the QCDs, qualified charitable donations from a IRA. So when you turn 73, currently that age is getting pushed back to 75, you start what are called RMDs, required minimum distributions. This is the amount the IRS has determined you have to take out of your IRA each year, and it triggers taxes. So let's say your RMD is $20,000, and let's say you don't need that money. Well, that $20,000 is going to trigger income taxes on all 20,000. You don't have to spend it. I mean, you could put it in a taxable account in your name, still let it grow, but you're triggering taxes on that distribution. Let's say you decided to give 10,000 to a local charity. If you give it from the IRA, that counts against your RMD. So if you have to take out 20,000 this year, but you give 10,000 of it out of the IRA to the charity directly, then what happens is that satisfies 10,000 worth of your RMD. You only have to take out the remaining 10,000. You're only paying income taxes on 10,000 instead of the full 20,000. So it can be a very effective tax planning strategy, something we help a lot of clients with.
And a note about that, I believe you can still do that when you turn 70 and a half, even though you don't have
Correct.
RMD requirement anymore because it got moved to 72 or 73 or now 75. But at 70 and a half, you could still take a distribution from your IRA and give that distribution to charity. You've reduced some of that tax deferred income. You've gotten it out of it's not taxable anymore, and you've given it to charity without having to possibly, again, if you take the standard deduction on federal, may not be getting any benefit for your charitable contributions. So something to think about.
Yeah, and at the top of the thing, we talked about the deadline for gifting for family or friends. We 18,000 per year is the amount that you can do. So it's 18,000 per person per year. So if you have a husband and wife and they want to give each of their kids money, it's 18,000 for each child from each adult. So they could actually gift each child $36,000 without having to reported on your taxes or anything like that. If you give more than 18,000, that can be done, but that does require an additional tax form that needs to be filled out. That's form 709. Now, the charitable gifting is a great way to reduce your state. So maybe you have a large sum of money. You're not going to need it the rest of it over your lifetime, and you want to help your kids now. And I see this a lot where I have, kids are in their 40s or late 30s. They're starting out a small family. They're trying to buy a home. They're trying to pay for their kids' college, all that sort of stuff. I see a lot of grandparents wanting to make contributions to their kids or give money to their kids at that time to help them out. So this is a common planning strategy we see as well.
Another quick suggestion I don't want to forget about, especially for grandparents and or parents, if you have 16-year-olds, 17 college, and they've got a part-time job, one of the best ways you can gift is when they get their W-2 in January, you look at their earned income and you make a contribution to a Roth IRA for them. They have to have earned income. So you do have to see what the amount is on their W-2 because it could be less than the max. But if parents contribute to that kid's Roth IRA, they will be rich when they retire.
All right. We were going to touch on this with the TCJA, the Tax Cut and Jobs Act, as we talked about. It's supposed to sunset in 2026. So it's going to revert back to the pre-TCJA numbers. with the election results last night, I would say let's hold on this because TCJA was done under Trump. So I'd say kind of put a pin in this until we know, but I think the general expectation at this point from colleagues I've talked with, Marilyn and others, that a lot of what we see in the TCJA probably is either going to get extended another 8 years or may become permanent.
Yes. Under current, I just looked at Trump's current plan, and one of the things is making the TCJA a permanent with some exceptions, with some adjustments to SALT. And so I think we just need to, as you said, put a pin in it, see what happens over the next year.
Yeah. All right, Erin, that is everything we had.
Well, thank you so much, Paul and Marilyn, for a great presentation. Before we dive into some of the questions here, I just wanted to thank you all for joining us today in case anyone needs to drop off early. We will be sending out a recording of the webinar so you can reference later. And as I mentioned, we would love for your feedback, including any topics. Sorry, can't talk today. I feel like that's all of us. As I mentioned, we would love to hear your feedback. I'll be sending out a survey here in a moment here, and the responses that we get from the survey have inspired a lot of our fall webinar series topics. So please, if you have a moment, fill that out. We'll also be sending out a PDF of today's slides so you can reference later, and a link to our BFSG YouTube channel where we post webinar recordings and other educational shorts if you're at all interested. That should be in the chat box now for anyone to reference. And as we begin our Q&A, please feel free to continue typing questions. We're going to get to as many as possible before our time is up. There's also a feature where if you see someone has already asked your questions, you can click that thumbs up icon, and that'll encourage us to answer that question faster. And with that, our first question, this is a quick one, just going back to clarifying on the gifts. Who can give gifts and who is paying the taxes on those gifts? Is it the gift giver or the ones receiving it? Do you mind explaining that a little further?
There's no taxation to either side on gifts. There's no income tax impact. So the person giving the gift does not get to take a tax deduction. The person getting the gift, it's not taxable income. It's just a gift, no taxable income tax impact. Where it does impact, so the first 18,000, there's no impact to anything. You just give it and it's done. If it's over 18,000, you do have to file a gift tax return to report anything over $18,000 to one person. That gift tax return, though, has no income tax impact no gift tax impact unless you're giving more than the current your personal annual exclusion, lifetime exclusion, I should say, which is $13.6 million. So if you give more than 13.6 or anything over 18 and up to 13.6, you still have no current gift tax liability. When you get over your lifetime exclusion, then there's gift tax consequences.
Yeah, and that's 13 per person. So if you're a married couple, it's 26.
Well, thank you. Now, should those who have a previous 401k account who then leave their employer, is it better for them to roll into their own account or leave their money with that employer's 401k?
That question is highly contingent on a few factors. So, what are the fees that you're paying at the old, where the 401k is at the old employer versus the new employer or an IRA? Are you concerned about being sued or asset protection purposes? What are the investment options? How is the money being invested? So really talk with a financial planner to help determine what's right for you in your situation. Like Marilyn said, if you're going to try and retire at 55 from a new employer, you may want to roll that other money over to be part of that bucket that you can pull from at age 55, for example.
Thank you. Now, for the cost of health insurance premiums, are those counted towards itemized deductions?
So health insurance premiums for a retired person would be part of your medical expenses. So your medical expenses are part of your itemized deductions, but they first have a hurdle of 7.5% of your adjusted gross income before you get any benefit. But yes, your medical insurance premiums are included in those medical expenses. If you're an employee and you're paying your employer, most likely it's being done pre-tax, so you're already getting a tax deduction for those health insurance premiums. If you're self-employed, there's what's called an above the line deduction for self-employed health insurance premiums. And it doesn't go into your itemized deductions unless you can't use them all as a self-employed health insurance premium deduction.
Now, could you go a little bit further into the catch-up contributions, especially the new plan that's coming as of 2025, where those age 60 to 63 could have higher catch-up contributions? And to follow up on that, can you also go into the Secure Act 2.0 new provision that would make these catch-up contributions Roth starting January 1st, 2026?
That is a lot of information.
I was going to say, I'll let Paul take this.
So yeah. Let's start with
one.
the easy part, okay? Right now, as it stands this year, it's 23,000. Anybody can contribute. If you're over 50 and a half, it becomes 7,500. Next year, the numbers stay the same, except for the base level goes up $500. The new addition is if your age is 60 to 63 and employed, instead of being 7,500, it's 11,250 in contributions that can be made. So I think that's the first question. What was the other part there?
The catch-up contributions that are going to have to now be made on a Roth basis starting in 2026. Could you go into that or make everyone aware of that at least?
Aaron, I will let you handle that one since you are institutional.
We are. So as of January 1st, 2026, catch-up contributions will need to be made on a Roth basis, according to Secure Act 2.0. This is being implemented by most employers, but you will want to double check before 2026 rolls around that Roth is an option in your plans. If Roth is not an option in your plans, these catch-up contributions will not be able to be made. So check with your employers prior to 2026, but we have about a year before that's implemented. So there's plenty of time.
Excellent.
And something else about the Secure 2.0 about the Roth contributions, I believe that there will be so right now when your employer does a match, they match your tax deferred account because that's not income to you. If they start, I think there's something in Secure 2.0 that they can start matching, doing some of the match into your Roth, but that will be taxable income to you. Since that Roth contribution is not a tax deduction for you, like the regular 401k contribution is, you don't get any tax deduction. If they contribute to the Roth 401k, it's going to be taxable income to you. But I'm not quite sure when that starts and how that's going to work. It's probably in this 2026.
Yeah, I believe it is 2026 that will also become effective. Thank you, Marilyn. I should also mention that these, again, Roth catch-up contributions will be for those eligible workers who have income exceeding $145,000. So FYI, and that's again for anyone over age 50 who is eligible for these catch-up contributions.
They like to make things as complicated as possible. So.
It's called job security for CPAs and attorneys.
Yes.
And financial planners.
Yes.
Let's see. Could you please go into some detail on tax write-offs for rental house expenses and if there's any sort of limitations or exceptions that need to be made for this? And a bit of a specific question, but.
So for a rental property, I mean, you can deduct everything you spend on the rental, gardener, property taxes, mortgage interest. There's no limitation to mortgage interest on a rental property, unlike on your house where it's limited to $750 or $1 million of debt. You can have $2 million of debt on a rental property. That mortgage interest is all deductible. Property taxes, maintenance, repairs, association dues, travel if it's out of town. Then of course the property gets depreciated. if the property you can take what's called the QBI deduction, qualified business income. There's some caveat to that, but if it's a triple net lease where you're not doing anything except for collecting a check on that rental and not having to pay anything, that does not qualify for QBI deduction, but there are instances where the regular rental, but for the most part, now of course, if you're doing major improvements, those have to be capitalized and depreciated. So there's really not any, whatever you have to spend on the house to maintain it is deductible.
I was asking specifically, just because they had some issues when filing that their TurboTax was the platform they were using, gave them an exemption to it. He was wondering if this was maybe because of his income bracket, or would there be any reason?
So once you take your rental income and then take all your deductions, including depreciation, you may have a loss. Now, you may or may not get to deduct the loss currently. So you still put in all your expenses, it'll create a loss. If your income's over $150,000, you're not going to get to take that loss currently, but it gets suspended and carried over, and that goes on another form in your tax return, and it carries forward. And when you eventually sell the house, you get to take that loss. Have another property with passive income, you get to take losses from one rental property against income from another rental property and offset those. Or if your income goes down below 150, you can start taking those losses. So there are still limitations. You can still take all your deductions, but again, if it creates a loss, that loss may be suspended.
Thanks for the clarification.
That's the issue with TurboTax is that they can ask questions, but unless you understand what the law is and how it's supposed to come out on the return, then it doesn't really serve you well to use TurboTax. And I'm not professing, using a CPA or a tax preparer, but because a lot of people with very simple, pretty straightforward returns can do TurboTax, but we do amend a lot of clients' TurboTax returns because they didn't understand where the numbers went or how it affected and where it came out, and it was not correct. So.
Thanks, Marilyn. This person has a question on if they were to leave an employer with the 401k at their previous employer, would they still be able to pull from that account while also having a 401k at their new employer, or would they have to roll this over?
So I'm a little confused on the wording here, but let me try and do my best to explain. If you have, let's say, $100,000 at your old 401k, you move to a new company and you start a new 401k there, you can leave the 401k there. If you take distributions, how it's taxed is depending if it's Roth or traditional, and if you're older than 59 and a half or not. So I would say reach out to us individually so we can talk about your individual situation to better answer that question.
I think you got it.
Okay.
If you receive money from an accident, do you pay taxes on this? Or how could you avoid a tax payment on this? I'm assuming this is coming from an insurance company. Would that be in the tax year? How would that be taxed?
If it's if it's money for your physical injuries, it is not taxable. But any part of the settlement that's for emotional distress, mental distress, pain and suffering, compensation for you not being able to work, that part of it is taxable. Only the settlement for physical injuries is not taxable.
Definitely talk to a CPA about your situation so they can determine how much would be subject to taxes and what the tax rate would be.
And attorneys usually don't really know the answer, even though they're doing this all the time. They don't want to give tax advice because they're not taxed, so they usually say to talk to somebody.
I do see we are coming up with about 5 minutes left here. We have about 14 questions. I think we'll try to knock all of them out. So we might go a little bit over, but just want to give everyone a heads up. This should be an easy one. Is a 401k withdrawal considered long-term gain, and how would that be taxed?
It's ordinary income. The money is never seen. That's income that you received that you've deferred payment on. So the growth in the account plus your contributions are all taxed at ordinary income tax rates when the money starts coming out of the account. So you don't pay taxes until you take the distribution, but it's all ordinary income tax.
This is going back to tax loss harvesting. I know we had a slide on that prior. How is this documented by a broker?
So at the end of each year, around end of January to mid-February, you're going to receive what's called a 1099 on a taxable account from your custodian. That's typically Schwab, Fidelity, whoever you're doing your trading through or wherever the money's held. They will report all that for you. You just give the 1099 to your CPA or use that with TurboTax to fill in that information.
Fantastic. In your professional opinions, do you think that Congress will enact an extension of the current estate tax exemption, which is due to expire in 2025, or would they increase that exemption? What are your thoughts?
The Trump tax proposal says that the plan was to make the estate tax under the Tax Cuts and Jobs Act permanent. That's what they're going to attempt to do.
Yeah.
Which all the attorneys who have been planning for this to expire are now either happy that they're not going to be working around the clock for the next year, or sad that they're not going to be working, getting a lot of money to do all this planning before the end of next year.
Of course. Going back to the standard and itemized deductions, for that 65 plus increased deduction, do both a husband and wife have to be 65 to take advantage of that, or just one if they're filing jointly?
It's per person. So if you have one that's 66, another one that's 60, the one that's 66 would get the deduction, the 60 would not.
And now calling back to the pass-through slide that we have, do you have to be a legit company, or could, say, a husband and wife create their own sort of company to take advantage of this?
Well, you'd have to have an entity, either an LLC, an organized multi-member LLC or S corporation, and then you'd have to have a business. So you'd have to have business income, because the California calculation is based on the net taxable income of the business. So, I mean, if you're operating right now as one of you is a sole proprietor, then it may make sense to become an entity, become an S corporation. There's complications that go with that, or become a multi-member LLC, like a husband and wife. And then you have a pass-through entity. I mean, there's cost in terms of now you have a separate tax return to prepare. And possibly if you're an S corp, you have to do payroll. So there are some other, consequences to that. But yes, it does have to have business income, and it's only based on the net income. If a business has a loss, you don't get to take any pass through, because it's 9.3% of the exact net business income on the California pass-through entity tax return.
All right, we are running a little short on time. We still have a lot of questions, so we're going to move to more popcorn, and we're just going to be a little more succinct in our answers, guys. So we apologize if we don't fully answer your question going forward. Feel free to reach out to us for more information.
If your investments are focused more in real estate and real estate income, what kind of strategies would you use to reduce your tax liability?
That one is a hard one to answer. It depends on the type of real estate that you have. Are you buying more property? Are you not? Reach out to us individually to talk more about your specific situation. I don't have any general answers here because real estate already has a lot of tax write-offs that they provide you.
Yeah, that's a very complex subject, and there's lots of forms of holding real estate, including through REITs and dividends through your investments. You can be, invested in a REIT
Yeah.
in real estate that way too. So it's hard to answer that.
I'll drop our financial planning email in the chat box momentarily for those of you to reach out one-on-one. Next question. Is there a specific amount that you recommend to initiate a Roth conversion?
It's completely dependent on each individual's tax situation, so that would be a holistic approach that we would need to take. Just know if you are in a lower income year or a lower tax bracket and you're young, the younger you are and the lower tax bracket you're in, the more sense it probably makes to make the Roth conversions or the Roth contributions. That's a general rule I would provide.
But in some cases they could do 5,000, if they plan it out, they could do
Sure.
5,000 each year just to get it going and to get to stay within a certain tax bracket. So I mean, you don't want to do it for $500, but there's no minimum.
Yeah, there's a lot of ongoing planning that can be done.
Yeah.
Yeah, I have some retayees where we're doing $6,000 a year, but we're doing that over 10, 15, 20-year periods where over time it makes a significant impact on their overall wealth.
For if your spouse is unemployed, but you're filing jointly, is that limit still going to be 23,000 in total, or would it be 46,000 for both spouses?
The 23 total, I assume this is applying to the 401k contributions that we've talked about.
I believe so.
That is per person.
So if one is unemployed, they would not be able to make that contribution.
No, they may qualify for like a Roth or traditional IRA contribution instead, but that would be based on their income. So talk with a CPA or a financial advisor.
For a Roth conversion, what kind of sorry, the converting on this question is a little funky. For a Roth conversion, converting from pre-tax IRA funds to post-tax IRA funds, what would trigger a penalty if done before the age of 59 and a half? Or would there be any penalty associated with that, with a Roth
Are they talking
conversion?
about the 10% early withdrawal penalty?
I believe so.
None to my knowledge. There are other rules. You have the 5-year rule that has to be implemented. But if you're say 35 and you do a Roth conversion, I don't believe that triggers a 10% pre-tax or early withdrawal penalty.
No, I don't think so.
Good question.
Moving on, regarding the super catch-up contribution, which is listed up here on this slide, is the amount for in addition to the 7,500 that you get over the age of 50, or is it separate?
Aaron, you are the perfect person to answer this.
I can answer this question. No, it is separate. So from ages 50 to 60, you would get that additional 7,500. Then from ages 60 to 63, it would just be that 11,250, not on top of the 7,500. And then it would go back down to 7,500 at age 64.
Next one I see is what if a 401k was rolled over to your current employer?
Thank you. Yep, that would be great.
Yeah, cool. No harm, no foul. As long as you moved from like pre-tax to pre-tax, you don't create any taxable events. That's absolutely one of your options. I don't think there's any more to add there.
Going back to that Secure Act 2.0 catch-up contributions having to be Roth, this will not affect you if you are making under 145,000 a year. This is just for those eligible for Roth for catch-up contributions and also making above $145,000 a year. Do I need to be watchful for reaching the maximum amount of savings in my 401k?
Typically no, because if let's say you set it to like 30% contribution rate and you max out your 401k in the first 5 months of the year, they're paying attention to the limits. Now, so let's say you're over 70 and a half this year. So we do the 30,500 total, the 23 plus the 7,500. The max total contribution that can be done is actually 69,000 this year to your 401k. but your 401k has to give you options to make after-tax contributions, which is a separate thing. So if you want to go above that 30,500 mark, talk with your HR to see if that's available in your plan.
I believe this question came in after we had just discussed the catch-up contribution for age 60 to 63. So the 11,500 is separate from the other contribution of 7,500. Those are two separate. They depend on the different ages, and they are in addition to that baseline of 23,500.
It is either or, it is not and. So you're getting 23,500 and 7,500 or 23,500 and 11,250, not both of those based on your age.
And just to go back on the balance question, to clarify, do they need to be watchful of the balance amount? This one just came in as a quick
For the
question.
401k contributions,
Yes.
I think it's worth paying attention to. Technically, no, if you're just trying to do the 30,500, they'll stop the contributions once you've hit that limit, but it is something good to be, watchful for. If you're set it up in a way that you're maxing out your 401k in 6 months, you may just want to lower the deduction and spread it out over the entire year to give you more money the first 6 months of the year.
The full balance of the 401k, not the contributions, I think is what he's trying to get at here.
Watch, that would be more so from an investment management perspective. It's good to watch the balance and as we talked about rebalancing portfolios earlier, either check the box if your 401k allows it to give you rebalancing done automatically. Otherwise, once per year at least, look at the allocation and make sure it's on track for the allocation you're trying to set.
I believe that was our last question, only 8 minutes over, so not too bad. Thank you for those that stayed with us this long. I think that was a really great Q&A session. I'm again putting in the chat box the PDF to today's slide, a 1 to 2 minute survey that I really implore you all to please give us answers for. Again, your answers will help inspire us for other fall and summer webinar series that we do every year here. And please feel free to scan that QR code to register for next week's webinar, which is a roundtable with the experts. We appreciate your time today and hope you have a great rest of your day.